90% of beginner investors lose money in their very first year. And no, it's not because they aren't smart enough. It's not because they lack access to the right tools. And it's definitely not because they picked the wrong stocks. It's because they fell straight into 3 psychological traps that Wall Street institutions exploit every single day to transfer money from retail investors directly into their own pockets. The truth that nobody tells you when you start out is this: investing is only 20% knowledge, but it is 80% behavior. You can spend weeks analyzing financial statements, and you can build the most perfect, high-growth stock portfolio on paper. But if your emotions take over the second the market gets volatile, you are guaranteed to lose money. Wall Street is a mechanism built to reward patience and punish emotional reactions. In this video, we are breaking down the 3 biggest investing mistakes that keep the majority of people poor and exactly how you can avoid them to build real, long-term wealth. If you want to master your personal finances, understand market psychology, and stop letting your short-term emotions dictate your long-term bank account, make sure to hit that subscribe button for Equity Lab Media right now. Let's dive straight into mistake number 1. Mistake number 1 is the FOMO trap. We've all experienced this exact scenario. You open your phone, scroll through social media, or talk to your friends, and everyone is hyping up this one specific tech stock, crypto asset, or hot new sector that just shot up 50% or 100% in a single week. You watch it happen day after day, feeling like a fool for sitting on the sidelines while everyone else is apparently getting rich overnight. Eventually, the psychological pressure gets too high. You give in, and you decide to buy. But here's the golden rule of Wall Street that you must memorize. When the hype finally reaches the masses, the smart money is already leaving. When a stock is experiencing a massive vertical rally, it is driven purely by hype, greed, and FOMO, and not by its actual financial value. When you buy a stock simply because the price went up yesterday, you aren't investing, you are gambling. You are buying at the absolute peak of human emotion, which almost always precedes a massive correction. Legendary investor Warren Buffett famously gave the world the ultimate blueprint for this by saying, "Be fearful when others are greedy, and greedy when others are fearful." When a stock looks like a rocket ship on a chart, that is the exact time you should be terrified, not excited. Instead of constantly chasing green candles and buying at the top, you need a strict, automated system. The absolute easiest way to defeat the FOMO trap is a strategy called dollar cost averaging, or DCA, by investing a fixed, predetermined amount of money every single month. Regardless of whether the market is at an all-time high or a temporary low, you completely remove human emotion from the equation. When prices are high, your fixed amount automatically buys fewer shares. When prices crash, that same amount of money automatically buys way more shares on discount. This ensures you never risk your entire capital at the absolute peak of a bubble. Mistake number 2 is panic selling. Imagine you finally take action and invest your first $1,000 into the market. 2 weeks later, a bad piece of inflation data drops, geopolitical tensions rise, or a major tech company misses its earnings report. The entire market reacts, and your portfolio suddenly drops from $1,000 down to $800. You see the flashing red numbers on your screen, anxiety kicks in, and your brain starts telling you, "I need to sell right now before I lose everything." Out of pure panic, you hit the sell button. Congratulations, you just turned a completely normal, temporary market fluctuation into a permanent, painful, real-world loss. The stock market is truly the only store in the entire world where people run out the door in a state of panic the second there is a massive sale on high-quality goods. If you look at the historical data over the last 100 years, the market moves in cycles. Crashes, corrections, and bear markets are not bugs in the system, they are features. We saw it during the dot-com bubble, the 2008 financial crisis, and the brief crash in 2020. In the moment, every single one of those events felt like the end of the financial world. But if you zoom out on a 20-year chart of the S&P 500, every single one of those major historical crashes looks like a tiny, insignificant speed bump on a highway that goes straight up. When the market drops, you haven't actually lost a single dollar yet. It is what we call an unrealized loss. It is just a temporary valuation on a screen. The only person who can turn that into a permanent loss is you. The moment you press the sell button, when the market turns red, the best thing you can do for your wealth is to literally close your portfolio app. Turn off your phone, go for a walk, and remind yourself that you are a long-term investor, building wealth for the next decade, not a day trader trying to survive the next 10 minutes. Mistake number 3 is putting all your eggs in one basket. A lot of beginner investors find one single company that they absolutely love, usually a high-growth tech stock that they understand or use every day, and they decide to put 100% of their investment capital into that one asset. They convince themselves that because the company is massive and successful today, it will simply rise straight to the moon forever. But even the greatest, most profitable companies in human history can face completely unexpected, catastrophic disasters. Structural shifts in technology, massive CEO scandals, new government regulations, or an aggressive new competitor can wipe out a single company's dominance almost overnight. Look at history. Companies like BlackBerry, Nokia, and Blockbuster were once thought to be completely untouchable. If your entire net worth is tied up in one or two stocks, you aren't building an investment portfolio, you are balancing on a tightrope over a canyon without a safety net. True generational wealth is not built on luck. It is protected and grown through aggressive diversification. You want your portfolio to look like an unbreakable fortress. The core foundation of that fortress should always be broad market ETFs or index funds that automatically hold hundreds of different global companies at the exact same time. When you own a broad index, you don't have to worry about a single company going under, because the other 499 companies in the index will lift you up and keep driving your wealth forward. Furthermore, don't just diversify across different companies. You need to diversify across different sectors of the economy. A bulletproof portfolio balances high-growth technology giants with stable consumer goods companies, healthcare, finance, and industrial sectors. This strategic layout ensures that no matter which specific part of the global economy takes a short-term hit, your overall portfolio remains stable, protected, and consistently growing. To recap everything we've covered today, if you can master your psychology to avoid chasing the FOMO hype, if you can refuse to sell in a panic when the screen turns red, and if you keep your hard-earned investments properly diversified across the entire market, you are already light years ahead of 90% of retail investors. Investing isn't about being flashy, it's not about making a lucky bet, and it's not about getting rich by tomorrow morning. It is about staying disciplined, remaining consistent with your monthly contributions, and letting the power of compound interest do the heavy lifting over time. If you want the exact, step-by-step strategy on how to build a fully diversified, rock-solid portfolio from scratch, click on the video on your screen right now, where we break down a perfect $1,000 blueprint for beginners. Thank you for watching Equity Lab Media. Make sure to leave a comment with your thoughts below, and I will see you in the very next video.